We have another 3 to 4 months before we think tariff impact peaks. So somewhere around the second quarter, you should see the bulk of that transfer come through, and then in more of an alleviation towards year end. But that shock is not over yet.
Hey, Miriam.
Hi, Tellis.
So I've got circled on my calendar for this upcoming week that Walmart is reporting earnings. Walmart, the newly minted trillion-dollar market cap company. Pretty exciting for a retailer. But here's the thing. How is Walmart hitting market cap records when all we talk about these days is the K-shaped consumer economy?
Right. And what that means is that the rich are getting richer while the poor are getting poorer. So why is Walmart booming?
We really wanted to put some more meat on the bones of this kind of K-shaped economy conversation. Because some things make intuitive sense about it, some things don't. So we are joined today by RBC Chief Economist Frances Donald. Frances, welcome.
Well, thank you for having me.
Why don't we start off by, why don't you tell us your definition of the K-shaped economy? Because I think it means different things to different people. So what does it mean to you, and what is driving it?
So, Miriam, you mentioned the rich are getting richer, the poor is getting poorer, and that is a standard sort of understanding of the K. And when you picture the K, you have that upper part that's rising and that lower part that's falling. Now, here's the bad news. That's actually always been true for several decades.
That's what I thought,
That was one of our first questions. Like, when has it not been?
Yeah, exactly. Right. So this wealth accumulation to the top 10% is not a new phenomenon. What's a little bit different here since about 20 and 23 is I want you to picture instead an E shape, which is that before about 2023, it was true that the rich were doing better and the poor were doing worse, but they tended to move along the same economic cycle.
So the parallel lines of the E was like you had a line up here and a line down here, and they were kind of
they were chugging along.
They were sort of going
along. But they weren't
along.
widening.
They were not widening to the same extent.
Okay.
Or the way I think about it is that you could kind of go to an airline with a consumer presentation and bring the same presentation to a dollar store, for example, and say your consumers, if everyone's, if the top's doing better, then the bottom's doing better as well. But in 2023, approximately, things started to behave a little bit differently. And it isn't so much that all of a sudden the rich started getting miraculously richer. It's that something happened back in 2023 that knocked us out of that E into the economy actually operating in many different cycles. And what that means is that most Americans are not experiencing the same tailwinds or headwinds to their environment as the top 10%. And so all of a sudden, data that looked at the masses or the bottom part of the K wasn't reflecting the aggregate amount of spending in the economy. So the reason that economists are so fascinating with this is because it's changed the way that we actually have to use economic data. One of the really good examples about this is that you might remember back in the summer of 2022. This may not stand out to you, but to economists, it is dark days. Economists called for a recession in 2023.
Oh, interesting. Yeah.
I was hoping that you wouldn't remember it because
we don't, because there was the famous recession of 2023 didn't happen.
Well,
right.
That's right.
Yeah.
So up goes, we all call for a recession in 2022. Why? Because at that time, consumer confidence was collapsing. Sentiment data looked as bad or worse than we've seen in past recessions. Sometimes it looked as bad as what we'd seen in the Great Financial Crisis. And so all of our economic models that relied on things like leading economic sentiment indicators, well, they weren't just red, they were flashing red really aggressively.
And why was sentiment so low back then?
Well, sentiment was low, interest rates were surging very aggressively, and so too was inflation, particularly in things like rent and food. So fast forward into 2023 and into 2024 and now up to 2026, and there has been no recession, and yet sentiment hasn't really remarkably improved. So there's been a lot of folks who say, well, maybe the sentiment data is broken. Maybe people are complaining, but actually things are okay for them. Maybe it's just vibes. It's feelings, not facts.
We've talked a lot about vibe session. Yes,
and we've had a lot of stories about that in the Wall Street Journal, how the data really doesn't match up with the sentiment.
And here's how I feel about this. It's not that folks are lying. It's not that they, watch too much social media or they're engaging in too much avocado toast or that they aren't experiencing a problematic economy.
That's why they can't buy homes.
Engaging in too much avocado toast. I love that.
It's something different altogether, which is that, if you go into a room of 100 people and you ask everyone, how are you feeling about the the economy, a consumer confidence indicator weights everybody the same. Everybody gets one vote in that. But when you go out in the real economy, that's not the case. Not everybody has an equal vote when it comes to total spending. We know there's plenty of data that'll tell you the top 10% of Americans spend 50% of all of the money. And so as the masses began to feel much worse for very real reasons, they were telling the truth about this. But when you looked at the total amount of spending in the economy, it's not everyone's voice that really translates to things like GDP or total retail sales. So economists have had this struggle, which is, well, do we ignore that confidence data altogether? Do we say, well, that's the K-shape and it's irrelevant? Or do you recognize it as just telling you something different? If I want to forecast retail sales or GDP, I can't spend as much time looking at something like confidence data. But if I actually want to think about the real economy, if I want to help companies understand who their customer base is, if I want to help policymakers make the right decisions, then ignoring things like confidence data and saying it's just the K-shape, that can be really dangerous.
So going back to Walmart, which we talked about in our intro, what is going on? Like, why is it that Walmart's doing so well right now? Is it sort of the common denominator for everyone?
Well, if you think broadly about how an economist might frame the consumer outlook, they'll say things like, well, it's not great, but it's manageable. So inflation is rising. We're probably have inflation stuck around 3%, but wages are more than that. So real wages have probably been floating around or have been floating around 1% for most of this year. Now, that's not a booming consumer economy, but it's enough to help you hold on. There's other elements in play that are distorting our consumer views. Do consumers front-load activities ahead of tariffs? So, for example, if you heard that tariffs are going up on furniture, did you buy more of that in advance? That might
Buying
be
the new iPhone before the tariff, that happened a lot, I know,
Exactly.
too. Yeah.
And then there's other issues that cloud our visibility as well. Like one area we don't have a lot of data, but we wonder now is buy now, pay later programs. So have we seen front-loading of consumer activity? This just doesn't show up in the traditional data points. And that's an ongoing issue for us is we know there are things happening in the economy that we don't have full visibility on, so we can have hypotheses and look for clues as they come along. But generally, the consumer in the United States is okay with huge distributional range all around it. So when I look at earnings reports, what we're looking for is comments from companies as to what people are buying. Are they shifting away from goods back into services? Are they buying essentials? Are they substituting out of discretionary into having to spend more money on things like food, for example?
Yeah.
So it's not the headline story that's as interesting to us as what are we learning about households in America underneath the surface of something like an earnings report.
And by real wages, you mean those are inflation adjusted, right? So people's wages are essentially keeping up with inflation?
Well, that's right. When we think about our consumers really being impacted by inflation, we take, well, how much have prices gone up and then how much have wages gone up? So really what you hope is that wages have gone up more than inflation. We call that the real wage. That's been floating around 1% now for over a year.
So when a retailer, say, reports earnings and you're listening to that earnings call, looking at the numbers as an economist, right? Not necessarily as a stock analyst, but as an economist, what kinds of things are you looking for? What pieces of data or signals are you looking for that help you kind of dial in that higher resolution of, okay, well, this is specific type of consumer, that specific type of consumer? How do you start to differentiate?
Well, it depends what the individual company is. But I'll tell you right now when I'm listening to earnings, I'm looking for a different word altogether, which is tariffs. How much of the tariff play have you filtered through? Have you absorbed all of that shock? Have you wanted to maintain market share and therefore you have not passed on prices? Do you intend to pass on prices? How have you offset the increase in cost? Because ultimately, at the end of the day, what I want to know is, are these companies who are serving consumers also keeping folks employed? Because there's what things cost, and then there's how much you're getting paid on the other side of it. And they all feed together into a really complex story. But the big question I have that I can only see in earnings that I'm not seeing any other data is, where are we in this tariff impact coming through? From what we can tell, we're probably we have another 3 to 4 months before we think tariff impact peaks. So somewhere around the second quarter, you should see the bulk of that transfer come through, and then in more of an alleviation towards year end. But that shock is not over yet. So as much as we should really be focused on how is the consumer behaving, I'm not sure that the shift in prices to which consumers will respond to is actually finished just yet.
So Miriam and I were talking about this just before we started recording, that actually like a lot of retailer stocks are doing really well right now. If you look at not just Walmart, but Target stock is doing really well. A number of others. And maybe what that goes to if looking at it through this lens, right? If companies are finally making adjustments, belated adjustments to tariffs, fundamentally changing their pricing and things like that, that might be a sign that actually, even though these stocks are rallying, it's not a good sign for the consumer because basically price increases are coming and could be negative for inflation later in the year. Do you think that some of those prices are going to start to that we're going to see that in inflation data at some point this year?
Yeah, we have inflation sticking around 3%. In fact, next month we're going to hit the 5-year anniversary of inflation above the Fed's 2% target. And sometimes I think, particularly after the pandemic, we get used to these large macro stories being really dramatic, double-digit inflation, recessions being the really big problems, and that your macro call, your economist call that really gets a lot of attention is the really big, dramatic, once-in-a-lifetime ones. But what we're witnessing in the United States is something that is a little bit nebulous and maybe I'll even say a little bit more nefarious, which is a slow creep, or what's that expression of the frog that's being slowly boiled?
Right.
That's how I think about inflation, which is that it's been stuck around 3% and is likely to stay stuck around 3%. Some of that is that the labor market is very, very tight. That's one of our best indicators of what services inflation will look like. Goods inflation is creeping up off the back of tariffs. Is it a dramatic breakdown? Not at all. But is it enough to keep prices above the Fed's target? Absolutely. And then we have some mechanical elements related to shelter that tell us that, well, your CPI indicator, that's probably going to stay at a level that historically we would have considered uncomfortable. Now, apparently, we're okay with it and it's the new normal.
We're going to take a quick break, and when we come back, we'll have more with Francis Donald of RBC.
Welcome back. Francis, one thing I wanted to – you mentioned a little bit people of different age groups, right? So Ks are not just rich, poor, asset-heavy, asset-light. What's going on with generational differences? Because we really are facing – I don't know, massive, we forget that this is peak 65. People are turning 65 and retiring in huge numbers. And at the same time, we know from past conversations we've had that the labor market is very different for young people, for Gen Z. Like how do we really need to differentiate between what's going on generationally as well?
This is my favorite topic right now because you're right. It's related to the K-shape, but it is perhaps even more disruptive to the standard way that we perform economics, if one could say, perform economics or execute economics. So you highlighted that we have an aging population, and I think demographics ends up being a secondary story for a lot of folks because they think, well, this has been going on in the background. We all know everyone will get old. What happened that changed the story or made it more relevant? Well, first, just the sheer volume. So about 1 in 5, just under 1 in 5 Americans is over the age of 65 right now. And so that has really critical implications. So labor force participation rates in the United States have been declining since about 2000, and they continue to decline. And yet labor force participation rate for what we call prime age workers, so it's 25 to 54-year-olds, that's at an almost all-time high. So if you're of that so-called prime working age, you are actively engaged in this labor market and you most likely have a job. What's happening to the United States economy, and I have high conviction on this, is that America needs workers, not jobs. And this is going to be fundamentally defining to this labor market going forward. Because in the last 18 months, there's been an incredible acceleration in retirees in America. We have over 2 million folks who are retiring every 12 months continuously. And just to give you some numbers, that change since 2 years ago is an extra 60,000 people a month that are leaving the labor force.
Yeah. Wow.
This is so dramatic that the United States right now has 3 retirees for every 1 unemployed new entrant that's coming in. So a lot of folks will talk about this no hire, no fire type of environment. You've probably heard this idea. It's very atypical. Usually if you're firing a lot of people, you're not hiring. If you're hiring a lot of people, you're not firing. They move separately from each other. But instead, both are frozen. Now, anecdotally, when I talk to companies, I'll say, well, things are going a little rough for you. Why aren't you laying off more? And they might say to me, well, I don't have to. I just wait.
There's a
People
natural
retire.
That's so
layoff
So
happening.
does this sort of counter the narrative narrative of jobs being eliminated by AI and because we might not need those jobs anyway because we don't have enough workers?
Well, this is for years what I would hear. I'd be asked all the time, what jobs is AI going to steal? But that narrative is changing very dramatically to thank goodness AI is here or we'd have a very serious labor shortage.
Wow.
But this retiree issue also complicates a range of our data because a lot of folks don't realize if someone retires and you replace them, it doesn't count as a new job creation. It doesn't come up in that famous non-farm payrolls number. So we have a hypothesis that there is a lot more hiring happening than shows up in a lot of our data. It's just not net job creation. It's that job exists and someone is coming and is filling it. But this is changing a whole range of issues. So, for example, when one retires, you get your Social Security coming through. And right now in America, about 20% of all income is coming from Washington. It's transfers from government. It's inflation adjusted, and it's not impacted by recessions coming through. So this creates a sticky consumer, right? The bigger the share of your income that's coming from Social Security, the less you have to worry about the stock market pulling back or what inflation is doing because you're going to get an adjusted income from that. So retirees are not just changing how people get money with less focus in the economy on income coming from wages. It's also changing how they spend. 22% of spending in America right now is on healthcare. So it shouldn't be a surprise that over half of the jobs created in the past year were healthcare. So the entire economy—
That might be like home health aides, nurses, things like that,
It
right?
can be. It can be anything related to medical services coming through.
Okay.
So it's absorbing a larger and larger share of income and spending. So you're going to see tension in that sector that really impacts our data. So sometimes over at RBC, we have a large number for job creation coming through, and we'd get some flack on that. You're not particularly bullish on the U.S. economy. Why is your number higher? And we'd have to say over and over, that number is no longer a reflection of how bullish you are on U.S. growth. It's that half of it is going to be healthcare jobs. So you're going to get this sustained element, this floor under how weak the economy can get as we move away, as the economy ages, as you see more and more retirees, you will see more and more of this sector, which is effectively acyclical. It doesn't operate like a regular business cycle. It's very disruptive to the standard way we've looked at the economy.
Are we in a softening labor market? Are we still in an overall tight labor market? How do you think things stand?
One of the hardest things right now is to separate what's happening cyclically with what's happening structurally.
Okay.
And by that, I mean we have these slow-moving, really powerful trends like the move towards healthcare hiring, which is going to remain. And then we still have a cyclical part of the economy that's going to move up and down. So when I say, for example, that America's biggest problem is workers, not jobs, that doesn't mean that we're not going to have periods of job weakness. It just means that the persistent trend and the bias is going to be towards a shortage of labor, not an excess of demand for jobs coming through. So the way to parcel this out is, first of all, recognize there is a lot of noise in our data. There's a lot of revisions in the data. I can't tell you how many times we'll stress as a team about what that non-farm payroll number is going to be on a Friday, put it into the system, really take bets on who's going to get it, get celebrated or the opposite of celebrated for getting the call wrong. And then the next month it's revised entirely differently and no one celebrates you a month after.
If you were right after the fact.
The first time, exactly. So I like to say that, we have two jobs as an economist. The first one is to predict what the number will be, and the second is to predict what's actually going on in the economy. And sometimes those numbers are different. In fact, I would say increasingly they are two very separate jobs.
So what picture does that paint of the economy overall? Do we essentially have sort of a shrinking pool of people who, okay, so there's not a lot of job creation, but everybody who wants a job has one. And so therefore, okay, actually consumers are doing okay, the U.S. economy is doing all right. Or does that shrinking mean that the economy is just not going to grow as much? And by the way, a shrinking labor market is also a big driver of inflation, right? Because that drives kind of, wage growth and price growth. And so, does that, you guys at RBC have talked about stagflation risk, which is a word that we were talking about a couple years ago. We weren't really last year. So what picture does this paint overall?
For as long as I've been an economist, and as long as you've probably been talking to economists, the view on the United States was if the consumer has a job, everything's going well.
Right.
Mm-hmm.
That was the thing. As long as the unemployment rate was low, the consumer is 2/3 of the economy, plus, then everything is fine and you can't be bearish on U.S. growth and you should not sweat a thing. Going forward, it's no longer our view that the best measure of the U.S. economy is do consumers have jobs? Because if you want a job in America, you will probably have one, putting aside some skills mismatch here and there going forward. It's probably going to be on the prices side, which is your job good enough to keep up with some of these rise in prices going forward? Which is why this concept of real wages or your wage versus price going up is so critical on a go-forward basis. It's also why we talk about this sort of uncomfortable connection between a tight labor market, which is good. We want Americans to have jobs, and what it does to inflation. Because one component of inflation, services inflation, the best predictor of that is wage growth. And a tighter labor market does tend to mean that wages are probably going to stay somewhat more elevated. So how does this feed into the broader inflation view? And this is where the AI story becomes so incredible because you commented there that if you have smaller people working, doesn't that mean your economy will slow? Well, an example that I've used for a really long time is think about any economy. I'm going to help you bypass a PhD in economics and boil it down to one simple framework.
Oh, that sounds great.
If you think about an economy like a fast food restaurant, do you have a favorite fast food restaurant?
Taco Bell? I don't know.
Taco Bell. So if you think about Taco Bell,
Me on the spot.
I didn't think that was a hard question, but I can retract it. Okay, so think about an economy like a Taco Bell, and the GDP of this economy is the number of tacos it creates.
Okay.
And the number of tacos that your Taco Bell creates is always a function of two things and two things only, which is how many people do you have working behind the counter and how fast does each person make a taco? And that could be they're using technology as aid. It could be do they have to fill out paperwork before they make the taco? Do they have to run around in a circle and do other forms of regulatory burdens beforehand? Are they skilled? Do they have experience? And effectively, that's to say that when we forecast GDP, we're always forecasting two things, your labor force and your productivity. So if you have less labor force in play, you can still make a ton of tacos. You just have to learn how to make them much more quickly than you did in the past. Yeah. And that's why productivity arriving right now is so critical. Because I see a lot of jobless growth coming ahead in 2026. Growth that's great for markets, not necessarily for people. And that jobless growth is only possible if productivity really comes to fruition on the other side. So you've spoken to one side of the equation, but there's this whole other side. Problem with the other side is I'm not a futurist, and it's hard to know just how effective this productivity will be on the flip side. It does, however, completely change the discussion about does AI steal jobs? No, AI is going to help us offset a shortage of jobs.
That's a fascinating framework. Yeah. We've not heard anyone on this podcast talk about that. So it's really interesting. But I also want to go back to the Gen Z question because it seems like, as Tellis mentioned, like that group is really in a different position when it comes to like job prospects. I mean, and we've talked a lot about how AI could really undermine junior level jobs. What about the next generation that's entering the job market? What about them? Like, will there be demand for them? Will they be able to find, real wages, that keep pace with inflation?
Well, I certainly hope so. At the moment, we have seen a pretty big uptake in what we call youth unemployment, which is 25 and under. Although I don't think you should tell a 24-year-old that they are youth. I think they like to believe that they can enter the labor market.
Some of them do. Some of them like to play
video
games.
But a 35-year-old would love to be called youth.
Yes,
exactly.
I would be happy being called youth.
Exactly.
Yeah.
So we have seen a big jump. Now, this isn't just in the United States. We actually see this in developed economies all over the world right now, this jump. Now, part of that could be that before soft patches in the economy, we do tend to see folks pull back a little bit on new hiring. And so who gets pulled back on hiring? Well, it's young people who are entering the labor market. Others might say, well, it's some of these companies being more introspective about maybe some of that tariff pressure coming through and saying, where can we be more efficient? Or it could be companies that are saying, well, we can maybe utilize some of this transformational technology. Can we replace some of these junior rules? And we're in exploration. So on the topic of youth, I tend to think about AI's adoption in the economy as maybe going through a bit of an adolescent phase in that it will be bumpy and experimental, but we have already seen a weakness in that particular group, and it should be watched very carefully.
Well, and to your point, Miriam, I think what you're saying is really profound because, we've all been talking about for a long time, the graying of America, right? And how will we pay for that? And maybe AI gives some of the answer, right? People will be able to just produce so much that it will essentially, pay for our retirees.
This is honestly the most optimistic take on AI I have heard yet.
And we know, Miriam, you've been writing for a long time about, the whole, private credit is going to go into the portfolios of retirees. What is private credit doing? They're funding all these data centers. So it all kind of starts to make sense. But to what you're saying, though, is so interesting. Are young people going to be the beneficiaries? Will they be the ones having those AI-driven jobs? Or is it the middle generation, middle-aged people will build these AI systems, put them in place, they'll get rich doing that, and then young people will just have nothing to do. So I guess that's the worrisome part of this.
Yeah, we don't know how productive these AI systems will be.
Exactly. And like I said, it's really early. I mean, ChatGPT came in 2022. Yeah. A lot of these young people had already picked their major before that technology even came to market. So again, this sort of adolescent phase. But I'm really, I think a lot about all those years when they would ask me, what sectors will AI steal jobs from? I can remember the charts. They haunt me of, finance is going to be this amount, science is going to be this amount. But I don't remember ever seeing a single chart that said it won't be a sector, it'll be an entire demographic. Mm-hmm. And that's what haunts me.
We're going to take one quick break. When we come back, more questions for Frances Donald, Chief Economist for RBC. Frances, what economic indicators would you put at the top of the list of things that people should care about?
Well, it depends what the end goal is. And maybe, if I may, I could share a quick personal story with you, which is that the bulk of my career was in asset management. So when you're employed in asset management as an economist, your job is to predict GDP, and then it maps to what will the S&P 500 do, what will the entire yield curve do. And so I always thought about GDP and retail sales as this sort of esoteric number, this game that I had to figure out, which fed into what does it mean for the stock market. And in this new role that I have working on the bank side, I spend so much more of my time talking to individual companies, CEOs and CFOs, about what their economy looks like. And instead of thinking of GDP as this top-down magical number that should then filter down into everybody's story, I've started to realize that the economy is the sum of all of these individual stories under the surface. And so what indicator do you want to look at? Well, what's your goal? If your goal is to trade the S&P, then you can look at things like GDP, total retail sales, productivity, CapEx, the very traditional indicators. But if you're running your own business and you have a consumer group, let's say you really like to target millennials with families, then you need to be really aware of how interest rate burdens are impacting them. Credit card defaults, largely irrelevant if you're trading the S&P, at least till this point. Incredibly relevant if you're really looking at that particular consumer group that takes on a lot of debt. So the main message for me is it's not so much, a playbook for each individual thing, or it's not so much that you should have, a specific playbook with a specific set of indicators. But what I try to tell my clients all the time is just be wary that the average is probably reflecting no true economic story under the surface. And if you're thinking about picking stocks, or you're thinking about running your own businesses, or even your own situation with the economy, the standard numbers just don't apply.
It seems like that is the real lesson of the whole K-shaped economy. I mean, is that you really need to parse through it and figure out precisely which group you're talking about to determine whether they're doing well and their economy is doing well.
Yeah, and the bottom line is that if you want to understand Walmart's business, frankly, the most important thing to do is probably listen to Walmart's earnings call, look at their specific customer base and understand that. And that maybe, I don't want to invalidate the whole episode we've had just here, but talking macroeconomics can not necessarily help you when you're thinking about a particular sector or company. Well, this has been a fascinating conversation. Frances, thanks so much for joining us.
Well, it's been a pleasure. Thank you so much for having me.
There's no CNBC Canada edition, is there?
No, we just watched the American one. Right, we also watched the American movies and American music.